Well,
I really need this class.
Sure. Well, equity is kind of an accumulation of a lot of the stuff in this section. So this bottom piece here, equity depends on kind of the organization. So this organization here has capital stock that was issued at par value. It's got additional paid-in capital, and it's got retained earnings. Not every organization has additional paid-in capital. And in the capital stock, everybody has capital stock, but it may or may not be valued on your face of your financial statement, because capital stock is always represented at par value. And a lot of small businesses, when they first form their articles of organization with the Kansas Secretary of State or Missouri Secretary of State, they say that their stock is going to be a par value of 0. And so if you have issued 1,000 shares at par value of 0, there's no number on your balance sheet for that number. And most people aren't really buying stock from their own companies, so there isn't any additional paid-in capital for the cash that you can necessarily put in. So
what's par value?
Par value is in the way the cost basis of the stock that you're buying. So I can say my par value of my stock is, I'm going to issue for anybody, I value my stock at $1. And so anybody from the inception, my par value is $1. And if I'm selling it for $2, then I've issued $1 of stock at par value, and I've also got an additional paid-in capital of $1.
So for like the DBE program, they look in that equity, the ownership, if there is capital, like who is the majority owner. So you have to be at least 51% minority or woman-owned to get on the DBE certified list. So that would be one of the things they look at. Really look at.
Really look at.
Yes.
There was someone in I think Wichita. They just got in trouble for that, but they were representing
that's
that they were.
C.P.A. That's McPherson.
Yeah, McPherson. That was,
yes.
Yeah.
That's a big deal. Yeah, that's a huge deal. And it basically turned out they were renting a veteran business or renting, two. Yeah. So yeah, that's what's called no bueno in the Monsignor. That'll get you in a lot of trouble.
I believe there's some jail time.
Or KDOT, or
yeah.
Especially federal funds.
Yeah, because you have to set asides for the DBs.
So any other questions? Retained earnings still plenty confusing. That's why they pay us the big bucks.
I guess I do have a question related to what you said earlier. So if you have, a company has an outstanding bill, you're waiting for somebody to pay you, when do you claim that income? When you get paid, or when you bill it?
That's a good question. Who are we reporting to?
So like the taxes for like September 15th, or April 15th?
I would say more often than not, for a small business, which would generally be defined as 10 million or less. It's a little bit higher now, I think it's 25 million. It's generally when you receive it. Generally. Now you can elect to do it when you bill it, but generally speaking, most small business owners are filing their tax return on a cash basis, so they're only paying tax on what they actually receive.
Thank you.
I've been told a lot that I answer questions with questions, because there's always a second question in accounting. So I think my financial advisor said, "Do you ever give me a straight answer?" I said, "Well, you don't ask straight questions." So it depends. So if you're going to be asking for lending, going to the bank, you're going to want to present yourself in the strongest position that you possibly can. And if you've already paid out all the expenses associated with creating this invoice and producing that revenue, your profit and loss is going to show all those expenses, but it's not going to show that revenue on a cash basis. So when you're presenting to the bank, you're going to want to make sure that you're putting that on your financial statements as an accounts receivable. So you're really tying and matching the revenues and the expenses. It doesn't necessarily mean when you go to file your tax return that you're going to have to pay tax on that. That is something that's different. And just because we've presented some financial statements on a GAAP basis doesn't mean we're filing our tax return on a GAAP basis. Does that make sense?
On a GAAP basis, I don't understand that.
That's the accrual. That's us recognizing revenue and expenses when it's incurred, not necessarily when we're receiving it.
Okay. So that's opposite of cash basis.
Right. Right.
Cash basis, kind of think of it like a checkbook register, like an accountant, when it comes in, and you count, and it goes out.
But again, if you're representing it to yourself, that's still one of those things internally that maybe from a tax basis you are filing on it just from a cash receipts perspective. But internally, when you're managing your business, you might want to be doing your books on an accrual basis, on a GAAP basis, so you can see, here's what my receivables are, how many days of receivables sitting out there, what's over 90, do I need to turn them over to collection. So managing your business is a lot of times different than how we're filing our tax return. Any other questions on that? So you'll notice on the balance sheet, the kind of two big number on here is the contracts receivable. But I think that the thing that's most up in the air, more often than not, from an estimate standpoint, is your cost and estimated earnings in excess of billings. And then on the liability side, you've got the billings in excess of cost and estimated earnings on uncompleted contracts. So those two items have the highest level of kind of variability in my mind on these financial statements. Most things are pretty straightforward. You know, I have this amount of cash in my bank. I've got these invoices that I've sent out to clients, and I have the paperwork for them. These two items are a little bit on the realm that we're estimating how much work we've done. And so we're recognizing revenue based off of how much we've done and matching the expenses along with those. So the costs and estimated earnings, those are jobs that you've extended your costs beyond necessarily what you've billed that client. So we want to make sure that we're matching the revenue and expenses that you have. So we're accelerating some of the revenue. It's not been billed, but we're accelerating some of that revenue onto the statement, the income statement, so we tie our revenue to our expenses. And if we've billed someone more than what we've actually completed, so if we've billed 70% of the job, but we've only really completed 50%, we're going to decelerate some of that revenue into a period in which we actually incur those expenses. And that'll show up as a liability on your books to say that, yeah, we billed them, we haven't done the work yet, so we might have to give this back to them if the contract actually ceases to exist. So those two kind of vary based off of really the estimate of the completion of the job. It's hard for us to test that as auditors. You know, a colleague was telling me the other day when he worked at Ernst & Young, and when they were testing percentage of completion of a highway job, the guy was driving on the road and said, "It looks done to me." So they went ahead and proved that contract was 100% complete because he went and drove on the road. But if we go look at a building that's being built, we're not experts in that building to be able to walk through that and say, yeah, all the wiring is done, so that looks 70% done. We kind of have to trust the individuals that we're working with and look at what you've expended to see if it makes sense for the completion of that job. Fraud has been perpetrated by using this percentage of completion method of accounting. When your building's down the street, it's still in its foundation stage. So there's plenty of fraud that occurs in this because this is truly kind of an estimate.
Yeah, regarding that, actually, the contract can be written so there's partial occupancy, so that the public, if it's a public building, can be in that facility, but the contract is not done.
Right.
So that's actually written in the contract. I work on most of the contracts I work on are that way. So there's a partial occupancy stage where humans can enter that space, but the contract is not done.
Right.
There's a lot of punch list items that have to be completed.
Right, and so we'll want to recognize that revenue over the time when you're still expending the funds to finish out that contract, not necessarily recognizing all the revenue or if they paid you a bunch up front. Any other questions on the balance sheet? Huh? All right, so the next one I kind of want to jump to. I mean, I think everybody understands a profit and loss statement. The next one I want to jump to is a statement of cash flows, which is page 4. I don't believe anybody likes a statement of cash flow but accountants. There are cash flow reports that I know Angela does for clients that are completely different from this, that are really more straightforward. This is my favorite report because we can always accrue and unaccrue and advance and decelerate income and expenses all day long on the balance sheet and income statement and kind of make those what we want them to be. But in the end, if we want to know what happened, you come to this report and you can see exactly what happened in your business. This one is done a little bit different. This is more of the direct method of accounting. So it really shows what we received from the clients, what we paid out to people, and what other income we've had. So these people, this business by itself made $368,000, but their cash didn't increase by $368,000 because a lot of things happened. So we bought some capital expenditures of $93,000, and we paid down some debt of $80,000. So understanding how our cash flow is working is incredibly important to running your business. This may not be the right report for you to understand that, but working with your accountant or your bookkeeper and saying, I got to understand how this cash flow is working. I see what I'm profitable, but I don't see that cash in my bank. I don't have any accounts receivable, I don't have any accounts payable, but my cash increase is not tying to what you're saying I'm making. And Angela can attest to this, that I don't think anything makes business owners more upset than when I tell them, well, you're paying tax on $200,000 worth of income, and they say, I didn't take home $200,000 of cash.
Yes.
And then we have to go through, yes, but you paid down debt of $100,000, and you did this, and you bought a piece of equipment, and we're amortizing over 7 years. And so a lot of things happen that isn't just necessarily showing up on the balance sheet and necessarily showing up in the income statement. You kind of have to marry them all together, and that's what I always felt like the cash flow statement does. It kind of marries them all together and really shows you what happened. So you can always back in and say, well, I made $300,000, but I really only increased 70 because I bought some equipment and I paid off some debt. Gives you a little bit more information.
So in that particular example, then like what if there was like a piece of equipment that was bought that was like for a job? Would that be a capital expenditure, or would that just be like the cost of goods sold?
I think that typically if you're going to use that asset going forward beyond that job, then it would be a capital expenditure, and you'd appreciate that over its useful life.
Okay, yes.
If you're buying it specifically for that job and you're going to get rid of it afterwards, you don't depreciate assets that are acquired and sold in the same year.
Gotcha.
So I would say you would have a pretty reasonable case to just expend that as a cost of goods sold. Your accountant may argue that because we like to follow the rules, and it says on a piece of paper that anything that has a useful life over a year, you put as a capital expenditure. So it kind of depends on facts and circumstances. See, I didn't give you a straight answer.
That makes sense. Yeah.
So this is the report that I think is incredibly important to all business owners, and it may not be this format, but work with your accountant or your bookkeeper as you're managing your business to come up with something that helps you manage the business from a true cash flow perspective. Understanding how my profit and my cash flow are working together. If you have no debt, it's a lot easier. If you have debt and you have to buy equipment, it makes it just adding 1 plus 1 doesn't always equal 2 and those things. So having something like this is really important to running the business. Do they have any questions on that?
I have a question. Capital expenditures when you go out and purchase a new piece of equipment, correct?
Mm-hmm.
What if you're gifted a piece of equipment? How does that show up on your financial statement?
Well, you as an individual would be gifted that piece of equipment.
Okay.
and then you would be contributing that asset to your business. If it's something where the asset was sitting there and no one was taking it, so it was trash or what have you, and you were able to use it in your business, most of our assets in our business on our financial statements are recorded at cost. So if you didn't pay for it, there wasn't any outflow for it, it's probably not going to show up on your financial statements because there is no cost associated with the acquisition. There are certain items on here that are presented at fair market value, but something of that nature, when you're gifted something, you inherit the gift. You're gifted the basis of that individual as well. So if it was gifted to you, you contributed it to the business, and the basis that individual had, your contribution to the business would be that basis. So you would have a fixed asset of $100 and then probably additional paid in capital of $100. So then it would show up on your books at $100, but it wouldn't necessarily show up in the fair market value at the time of the gift.
It would not show up as fair market value.
Most likely it would not, because there really isn't a cost associated with the acquisition of that.
Okay.
So then, if you go to sell it, say it's a property, what do you use as the cost basis for your taxes, capital gains taxes?
Sure.
What do you use as a basis if it was gifted to you?
The basis of whoever gifted it to you.
The basis of the fair market value?
So if let's say that your grandparent bought Microsoft stock at the beginning, and they bought it for $10 a share, and they have 10 shares. So their basis in that thing is $100. If they gift those 10 shares to you, your basis is $100. And so if you sell it for the current market value of what's Microsoft trading at now, $100 a share or something, you'd have a $90 per share gain. And it'd be similar for a piece of equipment. If someone gifted you that equipment and they bought it for $10, that ends up being your basis. Now, if you
have to know it. What if you don't know the information? You know, the person died, you have no idea. Like, what was their basis for it?
Typically, what I would do is try to figure out when they acquired it, and if it's stock, per se, for example, you can go back and look at the historical value of pretty much any stock back to when they formed. So we would say, well, we know they bought it somewhere around 1979. And if we don't know the month, I would just look at the average value of that stock for that given year, and I would use that as the stock cost basis for them. And then a lot of times I'll look and see if there was any dividends that were issued in those given years, and maybe there was a dividend reinvestment program that I might increase the basis a little bit for the dividends that would have been reinvested during that time period. But a lot of times I won't do that because that's an assumption that we elected to have dividends reinvested versus receiving the cash on those dividends. So similar thing, it's a lot harder for if someone gifted you a tractor they bought in 1920. But a lot of times you can kind of figure out based off of other people's expertise what a tractor was selling for in 1920. So you have to do
the
a
value
little
of it in 1920, not today's value. Say like if
Right.
it's a unique product now, maybe its value is more now. You actually go back to the original.
If they gifted it to you, yes. If you inherit it, that's different. If you inherit it, it's at the fair market value at the time of death.
Inheritance. Okay. All right.
And just also keep straight to individual transactions versus business transactions, because it can get murky. So just always be clear when you're talking to your accountant or whoever, the correct fact pattern, because that's kind of helpful.
Right.
Well, one more example, if I may. Let's say you're given a truck. The truck value is worth $10,000. Do you begin to depreciate that asset over time?
Well,
does it show up on the balance sheet as an asset?
If they've gifted it to you as an individual, because really businesses can't gift. Only people can gift.
Huh.
Only people can gift, because businesses and corporations are not considered individuals. So they can't actually gift anything. Only individuals can gift. So it would end up having to come to you as a gift, and then you would contribute that gift. And if you exchanged it for stock or equity in that business, then at that point in time, you could, in theory, put it at the fair market value of that asset at the time of contribution to the business, and then you could start depreciating that asset at the fair market value.
Okay. In this particular case, my brother's business gave me some assets. He gave them to me, or he gave them to my business?
He can't give. His business can't give.
I better tell it.
His business can't gift.
Okay.
You'd have to structure that a certain way.
Yeah. I was saying, wouldn't you have to do something like he's selling it to him and they come up with whatever fee or cost?
For a dollar.
Yeah. You'd have to You'd have to come up. You'd have to get creative about that to get that on your books.
Yeah, that's
It is for a dollar.
So for example,
yeah.
for example, I had a guy that wanted to donate. He sold his business, and he had this long-term employee, and he wanted to give this guy some land out of his LLC. So you can't do that. So we created a new LLC, exchanged that land for equity in this LLC, but he didn't actually he wanted a deduction for the gifting of that land. Well, there's no deduction for gifting of the land. But if you sell your units, your membership units in this LLC for $1, then you will, in theory, have a loss on the value of this LLC, the sale of this membership units, the difference between your basis and that land and what you sold the fair market those units for. So it's $49,999 capital loss for him, which he's got plenty of capital gains to offset. And then when that guy buys that membership units, his basis becomes $1. But when he sells that land inside the LLC, its basis is still $50,000. So if he turns around and sells it for $50,000, he has no gain. But when he takes out all the cash out of the business, he has distributions in excess of basis of $49,999. So he ends up paying capital gains tax on the excess distributions of his LLC when he closes it. So you see, there's a way around doing it, but you've kind of got to jump over hoops, climb under stuff, and finally get to where you want.
To grandmother's house.
Right. So he could distribute you don't ever really want to distribute assets out of like an S corp because that's a deemed sale.
Okay.
So whether he sold it to himself or not, they would say there was a sale. If you had no basis, the value is $12,000. You're paying tax on $12,000. So you want to make sure that you've thought that thing through and talked to the accountants of how this deal is going to come to fruition. Get it out of his business, sell it to you for $1, and you in turn may contribute those assets to the business for equity in your business. So then you would be able to write up the basis of that asset to the fair market value at that time.
This might be off the trail, it might be on the same thing. I might have an opportunity to buy some land close to where I want to build my garage. And the land bank has it in Kansas City, Kansas. I may only buy 3 or 4 parcels at $1. How would that look on the kind of in the vein of what we're talking about? Mm-hmm. Here I'm buying land that maybe $1, but the value might be greater than $1. Mm-hmm. How does that fit in there? Or does it?
You buying it as a business or as an individual?
Buying it I'm just going to buy it. If it's advantageous to buy it or into the business, I will.
Don't buy it in your business.
Do?
No.
Don't?
I and Angela may disagree with. I don't like having building or land in the business in which you're operating.
No.
Always either have it you personally or have a separate LLC that owns those.
Because that's what we did.
Right.
When we bought our warehouse, and we had that as in a separate, as an LLC. Mm-hmm. And then we've got our construction company, and they're separate, totally separate.
Right.
So one of the things I tell people when they go into business, and we kind of talk as I get to know them better, is always have an exit strategy. Like if I had to exit tomorrow, what would be the cleanest way to get out of this? If you've got everything intertwined with your business, I agree with Chris all day long that we should not. Because some people have buildings for investment properties, and sometimes they'll sell the building and then the business separate. You don't want, no.
And it's a little bit of risk management in my mind too. It's that, we all try to run our businesses as efficiently and effectively as possible, but stuff happens sometimes, and people get hurt, or we don't do what we necessarily say we were going to do. And if we get sued and we have all these assets in this business, we have everything at risk. We have everything at risk.
And that was why they told us, so we have our personal life, we have our business, we have our building, our warehouse, and then we have our business. So if something happens in our business, they can't attach our building and our personal. You keep it all separate. So that way, God forbid, something happens, they can only get to so much. They can't get to everything.
If you do things, I'm going to answer this again with a partial question. If you do things the way you're supposed to be done, that is correct. If you commingle funds, if you have one bank, you have all these LLCs separated, but you have one bank account where you're paying personal bills out of all these things, you're paying this business's bills out of this business's bank account, you having that liability protection will not happen. They will view that as just paperwork, and it's all one and the same. So that liability protection you set forth for yourself isn't going to happen. The attorneys will pierce those corporate veils and attach everything. So when you do separate those things, it's important to truly run those independent of each other. That doesn't mean that money can't change hands, but do it at an arm's length transaction, have it agreed upon, make sure you're doing it on the you're renting that space, and we've got a lease agreement with that organization of leasing that space.
So I'm not quite understanding.
Well, I came today.
Because there's businesses that own their own property. Like this business might own this whole complex. So I'm not quite understanding the concept of if you have a business, you don't own the property that you work in or the land that you are on.
I would bet. So have you ever seen the movie The Founder?
Is that the McDonald's people?
Yeah, so there's the movie The Founder. So he was going to building the McDonald's franchises. And what he realized after a certain point in time is that he's not in the business of selling hamburgers. He's in the business of owning property. So what they did is separated the businesses that we own property and we run a business. And those aren't necessarily always the same.